Yeah, this is the third video of the series. It's been a few days, so we're going to continue on 1.6 the players. From a bird's eye view, there would appear to be three major players in the financial markets. Firms are net demanders of capital. They raise capital now to pay for investments in plant and equipment. The income generated by those real assets provides the returns to investors who purchase the securities issued by the firm. Households typically are net suppliers of capital. They purchase the securities issued by firms that need to raise funds. Governments can be borrowers or lenders, depending on the relationship between tax revenue and government expenditures. Since World War II, the US government typically has run budget deficits, meaning that its tax receipts have been less than its expenditures. The government, therefore, has had to borrow funds to cover its budget deficit. Issuance of treasury bills, notes, and bonds is the major way that the government borrows funds from the public. In contrast, in the latter part of the 1990s, the government enjoyed a budget surplus and was able to retire some outstanding debt. Corporations and governments do not sell all or even most of their securities directly to individuals. For example, about half of all stock is held by large financial institutions such as pension funds, mutual funds, insurance companies, and banks. These financial institutions stand between the security issuer, the firm, and the ultimate owner of the security, the individual investor. For this reason, they are called financial intermediaries. Similarly, corporations do not market their own securities to the public. Instead, they hire agents, called investment bankers, to represent them to the investing public. Let's examine the roles of these intermediaries. Financial intermediaries. Households want desirable investments for their savings. Yet the small financial size of most households makes direct investment difficult. A small investor seeking to lend money to businesses that need to finance investments does not advertise in the local newspaper to find a willing and desirable borrower. Moreover, an individual lender would not be able to diversify across borrowers to reduce risk. Finally, an individual lender is not equipped to assess and monitor the credit risk of borrowers. For these reasons, financial intermediaries have evolved to bring the suppliers of capital investors together with the demanders of capital, primarily corporations and the federal government. These financial intermediaries include banks, investment companies, insurance companies, and credit unions. Financial uh, intermediaries issue their own securities to raise funds to purchase the securities of other corporations. For example, a bank raises funds by borrowing, taking deposits, and lending that money to other borrowers. The spread between the interest rates paid to depositors and the rates charged to borrowers is the source of the bank's profit. In this way, lenders and borrowers do not need to contact each other directly. Instead, each goes to the bank, which acts as an intermediary between the two. The problem of matching lenders with borrowers is solved when each comes independently to the common intermediary. Financial intermediaries are distinguished from other businesses in that both their assets and their liabilities are overwhelmingly financial. Table 1.3 presents the aggregated balance sheet of commercial banks, one of the largest sectors of financial intermediaries. Notice that the balance sheet includes only a very small amount of real assets. Compare Table 1.3 to aggregated balance sheet of non-financial corporate sectors in Table 1.4, for which real assets are about half of all assets. The contrast arises because intermediaries simply move funds from one sector to another. In fact, the primary social function of such intermediaries is to channel household savings to business sector. Other examples of financial intermediaries are investment companies, insurance companies, and credit unions. All these firms offer similar advantages in their intermediary role. First, by pooling the resources of many small investors, they're able to lend considerable sums to large borrowers. Second, by lending to many borrowers, intermediaries achieve significant diversification, so they can accept loans that individually might be too risky. Third, Intermediaries build expertise through the volume of businesses they do and can use economies of scale and scope to assess and monitor risk. Balance sheet of FDIC insured commercial banks and savings institutions. So as we can see, the balance sheet is presented here in table 1.3. We have assets and liabilities column as we would have in a typical balance sheet. The assets column comprises of real assets, financial assets, and other assets. The real assets have equipment and premises, which are 111 billion, other real estate 13.2 billion, and then financial assets has cash, which is 1.6 trillion, investment securities 3.4 trillion, loans and leases 8 trillion, other financial assets half a trillion. Total financial assets are 13 trillion dollars. That's a lot. Yeah. Other assets, other assets include intangible assets, which are 350 billion, and other assets which are 692 billion. So total other assets are 1 trillion approximately. So total asset side is 14 trillion 893 billion dollars. Liabilities also equal to that. They are comprised of deposits, debt and other borrowed funds, federal funds and repurchase agreements, other liabilities, and total liabilities sum up to 13.2 trillion, plus the net worth, which is the equity, I guess, and that would be 1.6 trillion. So yeah, that's the balance sheet of a FDIC insured commercial bank. This is the balance sheet of FDIC insured commercial banks and savings institutions. So this is like multiple banks, like all of the banks that are FDIC insured. That's why the numbers are so high. So yeah, balance sheet of US non-financial corporations. So here we have more or less the same sort of table, different numbers, and this one's a bit bigger. The figures at the end are about 39 trillion dollars. So yeah, now we move on to investment companies. So we discussed about intermediaries, which help to connect households to companies and their shares and other federal government, etc. And now you move on to investment companies. So investment companies, which pool and manage the money of many investors, also arise out of economies of scale. Here the problem is that many household portfolios are not large enough to be spread across a wide variety of securities. In terms of brokerage fees and research costs, purchasing one or two shares of many different firms is very expensive. Mutual funds have the advantage of large-scale trading and portfolio management, while participating investors are also assigned a prorated share of the total funds according to the size of their investment. I'm sorry for the slow reading and the lack of energy today. I'm just not feeling well. So yeah, I'll try to cover as much as I can and then end the video. So yeah, mutual funds have the advantage of large-scale trading and portfolio management, while participating investors are assigned a prorated share of the total funds according to the size of their investment. This system gives small investors advantages they are willing to pay for via a management fee to the mutual fund operator. Investment companies can also design portfolios specifically for large investors with particular goals. In contrast, mutual funds are sold in the retail market, and their investment philosophies are differentiated mainly by strategies that are likely to attract a large number of clients. Like mutual funds, hedge funds also pool and invest the money of many clients, but they are open only to institutional investors such as pension funds, endowment funds, or wealthy individuals. They are more likely to pursue complex and higher risk strategies. They typically keep a portion of trading profits as uh, as part of their fees, whereas mutual funds charge a fixed percentage of assets under management. Economies of scale also explain the proliferation of analytic services available to investors. Newsletters, databases, and brokerage house research services all engage in research to be sold to a large client base. This setup arises naturally. Investors clearly want information, but with small portfolios to manage, they do not find it economical to personally gather all of it. Hence, a profit opportunity emerges. A firm can perform this service for many clients and charge for it. Investment bankers. Just as economies of scale and specialization create profit opportunities for financial intermediaries, so do these economies create niches for firms that perform specialized services for businesses. Firms raise much of their capital by selling securities such as stocks and bonds to the public. Because these firms do not do so frequently, however, investment bankers that specialize in such activities can offer their services at a cost below that of maintaining an in-house security issuance division. In this role, they are called underwriters. Separating commercial banking from investment banking. This is very important because a lot of people don't know what investment banking is and how it's different from commercial banking. And investment banking isn't actually, investing in a bank or the bank investing for you. It's actually much different than that, which I also originally thought before I knew what it meant. So yeah, separating commercial banking from investment banking. Until 1999, the Glass-Steagall Act had prohibited banks in the United States from both accepting deposits and underwriting securities. In other words, it forced a separation of the investment and commercial banking industries. But when the Glass-Steagall was repealed, many large commercial banks began to perform themselves into universal banks that could offer a full range of commercial and investment banking services. In some cases, commercial banks started their own investment banking divisions from scratch, but more frequently, they expanded through mergers. For example, Chase Manhattan acquired JP Morgan to form JP Morgan Chase. Similarly, Citigroup acquired Solomon Smith Barney to offer wealth management, brokerage, investment banking, and asset management services to its clients. Most of Europe had never forced the separation of commercial and investment banking. So the giant banks such as Credit Suisse, Deutsche Bank, HSBC, and UBS had long been universal banks. Until 2008, however, the standalone investment banking sector in the US remained large and apparently vibrant, including such storied names as Goldman Sachs, Morgan Stanley, Merrill Lynch, and the Lehman Brothers. But the industry was shaken to its core in 2008 when several investment banks were beset by the enormous losses on their holdings of mortgage-backed securities. In March, on the verge of insolvency, Bear Stearns was merged into JP Morgan Chase. On September 14, 2008, Merrill Lynch also suffered steep mortgage-related losses, negotiated an agreement to be acquired by the Bank of America. The next day, Lehman Brothers entered into the largest bankruptcy in US history, having failed to find an acquirer able and willing to rescue it from its steep losses. The next week, only two remaining major independent investment banks, Goldman Sachs and Morgan Stanley, decided to convert from investment banks to traditional banks, holding companies. In doing so, they became subject to supervision of national bank regulators such as the Federal Reserve and the far tighter rules for capital adequacy that governed commercial banks. The firms decided that the greater stability they would enjoy as commercial banks, particularly the ability to fund their operations through bank deposits and the access to emergency borrowing from the Fed, justify the conversion. These mergers and conversions marked the effective end of the independent investment banking industry, but not of investment banking. Those services are now supplied by the large universal banks. Today, the debate about separation between commercial and investment banking that seemed to have ended with the repeal of the Glass-Steagall has come back to life. The Dodd-Frank Wall Street Reform and Consumer Protection Act places new restrictions on bank activities. For example, the Volcker Rule, named after the former chairman of the Federal Reserve, Paul Volcker, prohibits banks from proprietary trading, that is, trading securities for their own accounts, and restricts their investments in hedge funds or private equity funds. The rule is meant to limit the risk that banks can take on. While the Volcker rule is far less restrictive than Glass-Steagall had been, they both are motivated by the belief that the banks enjoying federal guarantees should be subject to limits on the sorts of activities in which they can engage. Proprietary trading is a core activity for investment banks, so limitations on this activity for commercial banks reintroduces a separation between their business models. Investment bankers advise the issuing corporation on the prices it can charge for the securities issued, appropriate interest rates, and so forth. Ultimately, the investment banking firm handles the marketing of securities in the primary market. When new issues of securities are offered to the public, later investors can trade previously issued securities among them in a so called secondary market. For most of the last century, investment banks and commercial banks in the US were separated by law. While those regulations were effectively eliminated in 1999, the industry known as Wall Street uh, was until 2008 still comprised of large independent investment banks such as Goldman Sachs, Merrill Lynch, and Lehman Brothers. Um, yeah, but that standalone model came to an abrupt end in September 2008 when all the remaining major investment US investment banks were absorbed into commercial banks, declared bankruptcy, or reorganized as commercial banks. The nearby box presents a brief introduction to these events. So yeah, we talked about that, the merging of investment banks to commercial banks and their sort of downfall, if we can say that. And yeah, now we're going to talk about venture capital and private equity. While large firms can raise funds directly from stock and bond markets with the help from their investment bankers, smaller and younger firms have not yet issued securities to the public, do not have that opinion. Startup companies rely instead on bank loans and investors who are willing to invest in them in return for an ownership stake in the firm. The equity investment in these young companies is called venture capital. Sources of venture capital are dedicated venture capital funds, wealthy individuals known as angel investors, and institutions such as pension funds. Most venture capital funds are set up as limited partnerships. A management company starts with its own money and raises additional capital from limited partners such as pension funds. That capital may then be invested in a variety of startup companies. The management company usually sits on the startup company's board of directors, helps recruit senior management positions, and provides business advice. It charges a fee in the VC fund for overseeing the investments. After some period of time, for example 10 years, the fund is liquidated and the proceeds are distributed to the investors. Venture capital investors commonly take an active role in the management of a startup firm. Other active investors may engage in similar hands on management but focus instead on firms that are in distress or firms that may be brought up, improved, and sold for a profit. Collectively, these investments in firms that do not trade on public stock exchanges are known as private equity investments. So that was we talked about all the players that are involved in this game, in the game of finance and investments, and we talked about the commercial banks, we talked about the investment banks, we talked about venture capitalists and private equity, and we talked about how the financial crisis of 2008 led to the merger of investment banks with commercial banks, or investment banks collapsing entirely, like Lehman Brothers. So I think I'm gonna call it for tonight, since I'm not really feeling that well. And tomorrow, for day 4, we are going to do the financial crisis of 2008, which is happens to be my favorite subject and my favorite thing to talk about in terms of finance, since I researched about it and really got into it in my class 12th economics project. So yeah, going to looking forward to doing that in the next video, in the next part of the series. And that's it for today. Thank you.